Hello and welcome to the Daily Reckoning Australia YouTube channel. I'm Callum Newman, one of the editors of the Daily Reckoning. And today I'm joined by Gary Norden, who's the author of An End to the Bull, amongst many other things. Long career in trading and derivative experts. And I first came across Gary last year, actually. I read both his books. And this one has become one of my favorites, and it's called An End to the Bull. And Gary talks about his experience and how, if you're interested in trading, you want to translate his experience and how you want to go about it. And it's a fantastic book. It's probably, I can't think of a better trading book off the top of my head than that one. I've read it multiple times, and I went back over it last night because of the discussion we're going to have today. So Gary is a derivatives expert. And one thing I've seen pop up lately is called the SKEW Index. And I hit him up to ask him about that. And I'll show you why. Or perhaps I should say, welcome to the show, Gary.
Thanks, Callum. No worries. Good to be here. Thanks for having me on.
So this popped up in my reading. You probably can't read it very well, but I'll read it to you. So I'll read it to all of you, okay? So the headline is Market SKEW Index, flashing red. And so this was 13th of July. With US equity markets up 92% from their depths of March 2020 and a growing number of analysts warning of a correction, more investors are buying derivatives that would turn a profit if markets fall. As a result, the SKEW Index, the spread between the cost of those derivatives and the opportunity to profit from the market rally, has set a record. And the article goes on. So that's the end of the quote. Now, this jumped out at me for two reasons. One is, obviously, it seemed like it was indicating, trouble ahead. And we've got an algo guy at the business who builds the SKEW Index into one of his algorithms. So I hit you up about it, and you say to me, well, actually, I don't use the SKEW Index, and, for various reasons. Can you tell us why, or your thoughts on the SKEW Index and why you don't like it?
Yeah, thanks, Callum. So firstly, in terms of designing trades, SKEW is very important. And from a pro trader's perspective, we do use the SKEW, but the SKEW Index to me...
Actually, just before you go on there,
yes.
When you say SKEW, what does that mean? Like, it's not a common term.
No, true. That's a good point. So what we're looking at here is when you look at a range of options on a contract. So in this case, for example, the S&P 500. When you look at the pricing of those options, it's basically options that are further away from. So we have at the money options, and then when you go out of the money options, and obviously then you go far out of the money options. And what we find is that there's often that the out of the money options trade at a different implied volatility level than the at the monies. And often it's sort of simplified to suggest that it's like a smile. So the at the money options would be at the bottom point, the lowest of the implied volatility. And then as you go further away, you basically have to pay higher and higher premiums through implied volatility for the further out of the money options. Depending on the market, it's not always a smile. Sometimes out of the money call options don't trade at much of a premium to at the money. But usually in equity markets in particular, out of the money put options trade at a higher volatility, implied volatility than at the money. And the reasons are a couple. One is supply and demand situations. But another one is that when markets fall, and particularly when they fall sharply, we tend to see volatility spike. So it makes sense that if, for example, implied volatility right now in the at the monies was 13%, for example, if the underlying market fell 4 or 5%, it would make sense that those options which are 4 or 5% out of the money would trade at a higher volatility, implied volatility than that, than those at the monies, because if the market did fall there, we're going to see a spike in implied volatility and historic volatility as well. So that's what happens, that the market kind of inbuilds the fact that, well, if we do go down there quickly, volatility is going to be up. So therefore, people are paying a higher implied volatility there. So that creates what we call a SKEW, the difference between what the at the monies are trading at and what these out of the money options are trading at. And obviously, they're changing depending, as we say, on demand and supply. If there's a big demand for these out of the money options, then the skew could become very, very steep. If there's less demand for the out of the money options, these deep out of the money options, then the skew will flatten. So the difference might be 13% for the at the monies and maybe 15% for some of these out of the monies, a 2% sort of skew. But then at other times, it might be 13% for the at the monies and 18% for the out of the monies, a 5% skew. That would be saying that people are paying up a lot more for these out of the money options. And therefore we get into this where the SKEW index. So the more they're paying, the higher the SKEW index will be, essentially. So, and this is always changing, I would say demand and supply and the market makers as well, depending on their positioning, they could affect that as well. So that's how the SKEW works.
I'm thinking just to put it in a context. So in 2017, the US equity market had that long period where it just sort of trended up, didn't have many down days. That's where you're saying you get like a flat skew where probably a lot of guys weren't looking for that protection with the options. Whereas now it seems to be that they are. Why then do you not put much importance on the skew as it is now?
Yeah. So, why is using that skew is really important in constructing trades. So as an options trader, depending on that skew, I will construct different trades and you can use it to your advantage, the way that it moves. Where I don't agree with is the use and the assumptions behind what that SKEW index mean. And this goes towards, to me, one of the key things that I try to put out with the book and other things that I do, which is that the difference between professionals and amateurs. And in retail trading, unfortunately, a lot of these ideas that pros would probably consider retail ideas have permeated into the sort of semi-pro environment. So they've sort of picked up a head of steam and now they're almost accepted. And so what I'll explain it this way is that it's a difference in believing that these sorts of indicators are predictive. That's where I think is the mistake. So if you use technical analysis, and as you know, Callum, I think that technical analysis is garbage analysis. One of the key themes or assumptions behind it is that the market is ahead. So you use and you build indicators because the indicators tell you what the market's going to do. Okay. Now the professional view, and if you don't take my word for it, if you read any of George Soros's books, for example, any old school decent trader will tell you that the professional view is that isn't correct. Markets don't predict what's going to happen. Instead, they price in certain outcomes. And there's a big difference in those views. If you believe in technical analysis and these sorts of indicators, then you believe that the market is ahead. So if we frame this back to the SKEW index, the underlying view about using it in this simplistic way is that it's an indicator, that when the SKEW index is flashing red, when it's very high, it's telling you that the market is set for a crash. Okay. That's where I disagree. It's not saying that. What it's saying is that people have bought lots of put options or out of the money options. Okay. It's telling you how they're positioned. It's a leap of faith to then say that they're correct, that they're right in this. Now, if we look at this, so the SKEW index hit a high, its all-time high, which is what that article is based on, I think around the end of June, last few days of June, early July, at about 160. It was its all-time high. Now, if you use that as an indicator, in the sort of following couple of weeks, US equity markets continue to push higher and hit new highs. I think what you probably saw was because we were coming into earnings season in the US and equities are at an all-time high, it makes sense that investors were starting to protect their portfolio a little bit, use some of the profits and buy some of these put options. That makes sense to me, right? You're going into earnings season, equities are expensive, they're pricing in really good moves. It makes sense that people would use some of their profits, investors, money managers, and buy some put options. They're going to pay up for them. And the other point about this is going into earnings season, market makers are going to call the price of these options higher anyway. Absolutely. Because we're going into a time where, this is a situation where, earnings could be not so good. And this is a time we know over earnings season where you could get big moves. So market makers are going to price these things up anyway. and they know that investors are going to come in and start buying these put options to protect their portfolios. So all of those things lead to the fact that, yeah, that people are going to pay higher amounts for this. It doesn't mean the market's going to crash. It just means that people are protecting themselves. And so that's why we look at it in terms of how are people positioning, and then you can work out. Then the skill of trading is working out how they're positioned and what might happen going forward.
That's such a what seems simple but great observation, and it's so funny to me because literally, I've been investing around iron ore lately in my super fund, and that's been quite good. And I had started to think, well, at some point, do I start buying a few protective put options for that folio if the US market gets into trouble down the track? And I had not connected it in any way to the SKEW Index, like in that way. And yet here I am doing exactly what you just, or thinking about doing, exactly what you just described. That's so interesting. So one thing you talk about in your book that I don't think gets a lot of coverage is volatility, and you've mentioned it there, historical versus implied volatility. Do you see that same disconnect between what you call amateur and professional in volatility, how it's perceived or how it can be used?
Yeah, absolutely. And again, it comes down to simplifying these sorts of ideas, So for example, you see in the retail environment discussions around, well, if implied volatility is higher than historic volatility, it means that implied volatility is expensive. Options are expensive. No, not necessarily. One's backward looking, one's forward looking. It just says to you that people think that the next, the coming period is going to be more volatile than the past period. Again, it's pricing in. And again, I think one of the key themes of this is in the retail world, they just keep getting told that these things mean something, that essentially the market's ahead, that people know what's going to happen. If people know what's going to happen, there wouldn't be so many losers in this industry. So, and it's similar with the VIX. The VIX is called a fear gauge, right? So people say, oh, well, the VIX is high. It's a very simplistic belief as well, a bit like with the SKEW Index. When the VIX is high, it means people are fearful. Well, not always. And we saw that last year. So classic example that the VIX index measures the implied volatility of S&P 500 options with roughly 30-day expiry. And last year we saw, what was quite a new phenomena, but we saw all these a huge amount of buying of call options and call spreads and particularly in technology shares, but across the board really. So this buying in out of the money call options, which was quite new, in such size, that caused implied volatility to remain quite high at elevated levels, particularly relative to historic, and the gap was quite large. But it didn't mean that people were fearful at that moment. In fact, it was the opposite. People were overly bullish because they're buying call options in that environment. But it doesn't matter what options they buy. Implied volatility, if it doesn't matter whether people are buying put options, call options, if there's lots and lots of buying of options, implied volatility will rise. So there we had a situation where the VIX is high for, and very high for an extended period, but not because people were fearful, it was the opposite. So again, just referring to the VIX as a fear gauge is really a misnomer. And really you have to think, well, why is the VIX high or why is the VIX low and what people are doing? And that's where we get into this again, trying to price in what are they doing, and then that's what a skill of a trader is, then working out around it what's a good trade. Just
in terms of observing volatility, I was just watching my watch list today, and the market here in Australia, it's quite flat, I would say. It's not particularly volatile. If you were to grab the VIX or in any other way, what is high volatility for you and low volatility and medium, if you like, if that makes sense? Can you put a range on it, or can you point to something and go, this, like, things are getting volatile now?
I suppose you could look historically, and you can look at the higher percentiles and low percentiles, and generally, for example, if we looked at US, which is what the VIX is calculated on, if volatility, whether you measure it by implied or historic, if it's sort of sub 10%, you'd say it was pretty low, and I think if it was, then again, probably above 20% would be higher. But, in the situations of where we have these big market moves, you'll get implied volatility, going above 30, to 40%, and anything like that is high. If you're looking at individual shares, if you went to meme stocks last year, so, I was looking at, AMC, which is a classic, meme stock in the US, you had implied volatility of over 400%. I mean, in that environment, the Black-Scholes options pricing model just, it kind of falls apart. It's kind of like it's not supposed to have numbers like 400. So you had out of the money call options with deltas of 55%, whereas an out of the money option should sort of never have a delta above 50, but the model just sort of says it's too hard for me. So, in those meme stocks, you get this, 300-400% implied volatility, which makes trading very, very difficult. It makes it much more difficult to understand. So most of the time, luckily, it sits within within certain ranges.
Standard range,
yeah. And you can sort of see when it's popping, and it's really measured by ranges and not just intraday ranges, but close to close as well.
You have an example in the book where you talk about Fortescue versus Telstra. And it was interesting to jump, because the book's a little bit older now. It's 2014, roughly. Maybe you wrote it a little bit before. And both were around $5 at the time. Fortescue has since gone up to 25, and Telstra's gone down. Anyway, that's not important for the part of the book you're talking about. But you do it to describe how you can factor in volatility to making a trade decision, where you go, this is a hypothetical. Maybe the historical volatility in Fortescue was, say, 30%, but now it's the implied going forward is 15. Just want to talk about how that affects your position sizing and what you see. This is a hypothetical example, but how that volatility observation influences the decision.
Yeah, I think it's particularly it would particularly influence you if you're an options trader, and that because it will define what type of strategies you create, and it can provide opportunities as well. High implied vol or low implied vol, same with the SKEW, can provide you with great opportunities to create a strategy that if you can take advantage of both of those situations. If you're just trading the outright shares, then I think really it's an indication that you're trading. And what I was trying to say was that stocks that were trading at the same share price, you've got to treat them differently. So, if one's a much higher volatility stock than the other, you have to factor that in when, for example, your position sizing. Would you buy the same amount of a more low volatility stable stock that's paying a dividend against? So you can use these sorts of situations. And then, as Fortescue rallied as well, I was sort of saying, because I think that part of the reasoning for that comparison was, I think I'd heard an advisor here talk about, investors want volatility. When you buy a stock, you want it, for example, to double, and that's volatility, but it isn't. If a stock just keeps going up, that's not volatile. In fact, that's very low volatility. But yes, the stock price could go up and you've made money. But in that scenario, if you've small position size, for example, on Fortescue, you like it, but you realize it's a high volatility stock. You could small position size initially. And then as it grinds higher and you notice that the volatility is dropping, that's an environment where you can be more comfortable adding to that position. It could be one reason why you would add to it, not just because the stock's going up, but the way it's going up. If it's going up because, for example, today it goes up 5%. Tomorrow it goes down 3%. The day after it goes up 5%. The next day it goes down 2%. It's going up, but it's volatile. Would you want to be, continually adding to that sort of position? Maybe not. But if tomorrow it goes up 1% and the day after it goes up 0.5% and the day after 1%, 0.5%, it's going up gradually every day. That's going to be reducing volatility considerably. It's just grinding higher. And in that situation, as you noticed, that maybe the historic volatility of Fortescue is dropped from 20 to 17 and it's on the way down, maybe then you could say, okay, now I can start to position size this differently, and give you more confidence to add to that position size as that volatility drops. That would be one aspect of using volatility. So
another one for me, which I did quite a lot last year, because the back half of last year was quite volatile with the US election and the COVID stuff, and what would happen is you'd get these big down days, but I had a situation where I would be following certain stocks and I go, I want that stock, and so the volatility was a a way to get in at a low entry price for me. But obviously, for people already in it, that big down day, they start cutting because they're like, oh no, it hits their stop loss, or it's time to get out, or what have you. In your day trading, is that sort of similar situations you're looking for?
So for day traders, you're really just interested in that day and the sentiment, and that's one of the great things about for the day traders have is that today could be like in that COVID situation. One day the market's up 5%, everything's really bullish. Well, that day you're going to trade it from the long side very strong, and then you'll get flat at the end of the day, and then the next day if the market's tanking, you'll trade it from the short side. And so that's where day traders can be really nimble. They essentially get on the sentiment of that day and trade that as hard as they can. In the situation you were saying, when you've got investors, I mean, this is where having a balanced portfolio, owning some put options for protection, those sorts of things, as you're going into COVID, if you have any concerns, because those investors that were forced out of the bottom, clearly their risk profile of their portfolio didn't match the risk environment they were in. If, for example, they had have bought some of these put options, for example, to protect their portfolio, then those down days, they have this P&L boost coming in, they no longer have to are forced out. So those kinds of situations where people are facing that, it's really because their portfolio isn't structured correctly for the current environment, and that's why I'm a big believer, and I've done a number of seminars talking to investors about hedging and trying to explain it. It's something that is not done here very much. And, I say to people that investors in Australia, they have some of the largest superannuation accounts in the world, but they kind of never protect them. The vast majority of them never hedge those portfolios. And I say to people, how many in this room, if I'm talking to 50, 100 people, how many insure your cars? And they all do, right? And a car might be worth, 50,000 or 40,000 or whatever. How many of you insure your superannuation portfolio? And almost none. And that might be worth 500, 600,000, a million or whatever. And it's a massive failing, in my opinion. I talk about hedging. So they just suffer these big drawdowns. And the thing about hedging and insuring a portfolio is you don't have to do it all the time. But in fact, even if you did, it shows that it's quite a decent idea to give up some of your profits to continually buy some options, not many, but some to protect yourself.
And not to mention like just, sleep easy sort of situation. You can go to bed and go, well, I've covered my folio. And this is one of the points I wanted to bring up with you, because you mentioned in the past in your books and articles that you've been around for some of the big bubbles and Japan
too
and
many
stuff. Now, you may be of the view that the US might, well, I would assume that you would agree that it's at least expensive, and the bull market has been going on a long time. You would think that at some point it's going to run out of steam. So therefore, this idea of hedging has to come into play. But we could have said that 6 months ago, 12 months ago. As you say, when do you just keep rolling over your hedges in this case, and you go, I don't know when it's coming, but it is coming? Or do you start to go, no, I'm starting to see it break down now? Or what are you sort of watching and waiting for?
Yeah, look, it's a brilliant point. And I think that you have to understand that, as with any insurance, sometimes you'll take it out and not use it. And in fact, as an investor, you're probably happy that you don't use it. I mean, and again, bringing it back to the car, people don't say, I haven't had a car crash for 4 years, I'm not going to insure my car this year. Right? And realistically, how often does people have a car crash? Maybe once every 7 or 10 years on average, which is probably about the same time as they suffer a collapse in their portfolio, right? So, but they don't sit there and make that discussion with the car insurance. So I agree. I think, with a time when equities are extended and they are expensive, which they are, I think you just have to say that you want some protection in there, maybe not much, maybe enough to cover 10%, 20% of your portfolio potentially. But if there are any specific signs of something happening, you may then extend it. I wouldn't say necessarily right now there's something specific out there that would say to me, right, the market's going to go. And I can, and this reason, this is why people are looking at that SKEW index. And I just want to bring in something that when I was just doing some research for this, and if you look up and Google things like SKEW index, one of the explanations I saw was that it's a measure of fear. You can see when people are buying these options, and it can signal a black swan event. Like when lots of people are buying these deep out of the money, because they're generally, I think, 2 standard deviations away. I think they're measuring in the SKEW index. So they can sort of signal when a black swan event might happen. And I thought that was really interesting, because let's just sort of think through that. Okay.
Oh, hang on, I'm going to guess. You can't predict a black swan. It's not a black swan otherwise.
Well, exactly. If everybody's buying these out of the money put options because they think the market's going to collapse, it can't be a black swan, right? Because everybody's buying them. And that's one of the things, is that when the markets often turn, it's because people were not prepared. Not, if people are prepared, and all the investment managers in the world have bought all of these out of the money put options, generally it's less likely that the market's going to crash because they're all ready for it. When does the market sort of crash and have these falls? When people are not prepared, so that's why I think
you invert the skew. You go, I shouldn't be worried. It's really low.
but that's a fair point, and that's why I say about our job is really to work out what's being priced in. And when you work out no one's positioned for this, that's when people panic. So take those investors last year in Australia who were panicked out of stocks when they went down. If they had all bought put options and had all been hedged, the Australian SKEW Index would have been quite high, but they wouldn't have been forced out of their shares on those down days.
Yeah.
So you can see how that works in reality. So that's why your job as a trader and investor is to work out how people are positioned. And that's why these indexes, if the VIX is really, really high, the VIX pops after the market falls, usually, not before. If it was always that simplistic that, before every market correction, the SKEW Index goes up and the VIX pops, how easy would life be? We'd all sit there with managing huge amounts. But it's not like that. It's a lot more subtle than that. You're working out what's priced in, and it's more likely that things will happen when people are not protected. So I think that people bought protection in the US ahead of this earnings season, which is fair enough, but very much possible after the earnings season, they might not buy the next round of options. And maybe the skew will flatten again going into September, October, perhaps.
Yeah, absolutely. I just wanted to describe, part of what your book is, you talk about the difficulty of long-term forecasting and just trying to read day to day what's going on. And I have the ability to do that now with the role I've got. And I have a lot of sympathy for people that can't do it, because it's kind of like you're jumping in and out of the story all the time. And it makes it very difficult to get a grip on it. I know since I've started following the market day in, day out, and there's an element of boredom to it. It's like sometimes it's just not much really going on, and they shares wobble along and up and down. Really nothing insightful as such.
Yep.
But when I hit you up the other day, I said to you, we had a down day in America, and it pushed the open down on, I think it was a Tuesday.
Yep.
And I started flicking through all my watch lists, and I could just tell from the price action, there was no genuine panic. It was like a reactive thing. US is down. You get that sort of red, but I was just looking through everything, and I'm like, no one's panicking. Like, because I've been through last year and all that sort of stuff. And so I stepped in and bought, in this case, it was BHP, just because I'd done some work on it and I knew there was a dividend coming up and just a very simple thing. And then I think when the day ended green or what have you.
Yeah.
And that's an emphasis of yours, isn't it? Not looking for moving averages or RSIs. It's just looking at the price action itself. What's happening now? What's been priced in? And where is the edge?
Yeah. Yeah, I think it's very much about trying to be in the moment, and that's whether you're a trader or an investor. I think you have to just analyze the current situation and work out what the current situation is. But that last, it was quite funny because after that fall, which was kind of like a Monday, I think in the US, and a Tuesday here, was 1.5-2% fall in US markets. I got emails and questions coming in from people saying, "Oh, why is the market down? Why is the market down?" I was like, it can go down, all right? I grew up in a time where 1%, 1.5% moves were reasonably common. The market would go up, market would go down. And it's really funny. We're in a situation now where we've had like one decent down day, decent in terms of large in how many months. And then everyone's, "Oh, why is that happening?" Markets can do that. That's part of markets. And I think that there is a slight difference nowadays in that I think there's so much leverage in markets. I was talking to another pro trader a couple of days ago who runs another hedge fund, and saying this, that essentially like a 5% move in markets nowadays is probably like a 20% move in markets 15, 20 years ago, because of the leverage, because, people have so much leverage. So we've seen before, even I think early this year, 5% move killed a big hedge fund in Singapore. And we've seen previously a 5% move blew up some volatility funds a couple of years ago.
Yeah, I mean, those. That was 2017.
Yeah, it's kind of madness. From my perspective, I'm always trying to work out, but I'm not even thinking of 5% moves. I'm thinking of 10 and 15% moves when I'm working out sort of risk environment. But yeah, we're in a situation now, I think, because of the leverage, which is why now a 1.5–2% drop in the market starts to spook people. And this leverage, and in some markets even more, if you're looking at crypto, the leverage is very, very high. So realistically, a 5% move in that market is probably like a 30–40% move in others. So that they wipe people out. So, but this again is all about why we try to work out how are people positioned in this market, and what are they not positioned for? Because, it's when they're not positioned correctly that the surprises happen. And, one of the best traders I ever worked with is a mentor of mine in my younger days. He made a point to me once, I think it's in the book. He said, Gary, you'll make the most money on trades when you have the opposite position to everybody else. And it doesn't mean you always take the opposite position, but when the crowd is all long something and it turns out they're wrong and they all have to run for the exits, so that's where the money can be made, obviously, on the other side. But you have to have in your armory an ability to be contrarian, to do that. Not always contrarian, but you have to have that ability to be contrarian, to find those trades where, everybody's long, no one's protected. Whoa, and for example, let's say the company's going into an earnings season. Doesn't take much for that company to disappoint. Those are the situations where it's skewed towards, potentially going the other way.
I've got a great example of that. And I don't want to make it sound like I'm tooting my own horn, but just to emphasize it, how powerful it can be is go back to March, February, right? Rio, BHP, FMG started to sell down because all these investment banks were coming out saying, iron ore's peaking. Second half of the year, it's going to start trending down. China's maxed out now. Yada, yada, yada. And I can't even remember why I really got into it, but I started digging around, and some of the companies themselves were saying, we don't agree with that. We're getting really strong demand coming through. And then I started hitting up a few people sort of associated with the industry, and they're like, no, this is actually looking really bullish. And I was like, oh, and I'd never really covered iron ore before. I was like, this is great, because what you talk about in the book is what's priced in. What was priced in was a lower iron ore price. And I'm like, it allows us to get in. If iron ore does go down, well, it's already priced in. If it doesn't, the market has to reassess the whole thing.
Yep.
And there's just been so many opportunities from that, because, of course, iron ore then surprised everybody by going over $200. Nobody was talking about it, except one guy I know. And God bless him. So absolutely, the trading opportunities from that have just been prodigious. And one thing I've learned over the years, those things only come along every so often. Like, you've got to go for them when they're there, because it just takes time for the market to get too one-sided. And I mean, I would, if every month was like that, but it just doesn't happen. So that's just a perfect example from my experience. Now we're sort of getting to the end of that now, where everyone's like, oh, geez, it's going up and it's not coming down yet. So it's started to get built into all those prices. But that's what you're looking for, isn't it?
Yeah, and that also raises another point that's in the book as well, which is about the sell side of the industry, right? And you've got to look at what the sell side of the industry, and that means brokers and investment analysts out there. You've got to look at it with a little bit of a pinch of salt. And really what you should be doing is not, they might be coming out saying, we expect this. Really what you should be doing is, well, what's actually happening? Right? What's the actual price of iron ore doing? And you would have found, like you did at that time, it's not actually wasn't going down. So they're saying, we think it's going to go down. Well, that's just a prediction. And sometimes these predictions from investment analysts is more about trying to rotate people in and out and getting commissions in as well. Your job as an investor, as a trader, is just to say, okay, people are saying this and thinking this, and obviously some people acted on it and sold down those stocks. But really, what I say is, look at the data. What's the actual market doing? What's iron ore doing? And if it's still okay and looking good and going up, then you can just reject that kind of conjecture, basically. Because there's a lot of views and ideas, and really, if you just stick to what's actually happening in the market, then that tells you what you need to do.
It will hold you in good stead.
Yeah.
One I wanted to I remember last time we spoke, you mentioned that gold usually does, I know I'm sort of jumping around now, but gold usually does best in negative interest rates. Now, Mr. Market is playing tricksy to this a bit because US rates are very negative. But the correlation between that and gold for the moment has broken down. Yeah. Have you noticed that? And have you any thoughts on it?
Yeah, it's a great point, and it's a really interesting development. So, yep, the relationship historically between gold and real yields is the strongest relationship for gold. I think there's a few things, but I would say in general, when correlations break down or change or throw up something that's a little bit odd, it's a time for traders and investors to be a bit concerned. And if you see 3 or 4 correlations break down, what it's telling you is that people have different ideas, different markets are thinking different things. And that means that, they can't all be right. Okay. One thinks this, one thinks that. So I think is an environment where generally we have to sort of start to scale back risk and be very careful because there's obviously something happening. I think the problem is, I think partly to do with the Fed intervention in the bond market and the reverse repo, which is quite a technical situation, what they're doing in there. But I think that's created for a while, I think what I was calling kind of like a structural short in the bond market. So basically just created this huge demand for US bonds. And there's been discussion about, the bond market is suggesting that this inflation is transitory because real yields are so negative. I don't think we can say that actually. I think realistically what we can say is that because of what's happening in the reverse repo market and the bond market in general, that there's this demand for bonds that's not necessarily linked to people's expectations of inflation. And I think what's happening now is the gold market saying, yeah, we don't believe that anymore. We don't think this move is like we would normally expect with the bonds, that it's predicting inflation or not predicting inflation, but pricing in inflation expectations. I don't think that's what's happening. They think it's more technical. Therefore, gold's doing its own thing.
That's interesting because I'm of that view that it's been distorted, and I know it's been like that for a long time and that, but you can't, because some people go, oh, the bond market's pricing in lower growth because the bonds are rising, and you're like, well, really? Like because there's this other rule now that I read actually from a guy who I like, a correspondent over in the US, who talks about not only is it the Fed, now the regulators want the banks to hold all these bonds against their lending and stuff. It's just pushing all this demand in there. You're like, well, they're just buying it because they have to. It's not because they necessarily think anything. So it's super interesting that.
Which makes it more difficult for us, right? That it's now we can't use the bond market as we did before. That makes gold trading more difficult as well. And that's why I say in these environments where we start to have these disconnections and dislocations, then we kind of you just have to stay away a little bit and be a bit more careful. And it's I think a bit similar because we've had this quite big risk on rally for obviously equities for the last year or so, but in that environment I would say with a big risk on rally and the iron ore price, for example, so high, I think most people would have expected an Aussie dollar far higher than 73.5, 74 cents, right?
Me too, yeah.
And that as well is interesting. The strength of the US dollar during this, I think, again, partly it's because of this demand for US bonds, also creates a demand for US dollars. But that as well is, and this is why this rally is a bit different. And I think it's a bit more complex to try and figure this out. And particularly right now, the one thing I will caveat with this is we're in the summer months, not here in Australia, but in the rest of the world where the financial markets are bigger. And summer months, the volumes drop, the liquidity drops, a lot of the big players are staying away. So we can get moves which are not quite coordinated because it doesn't take much to move certain markets. So, personally, I don't take a lot of, that's why I don't trade and put a lot of position sizing in these summer months, because we can get these kinds of disconnections. So, personally, I'd sit down and look at them. And I just think it says to us, be very careful right now in positioning because there's so many different dislocations. And then, reevaluate again, come September when everybody's back, and to see then, I think is when I think we'll get to see more of how the picture is going to start to come together.
Well, it's so interesting, like when you talk about like putting multiple watch lists together and reading signals, just I can observe the gold stocks here and they're not moving. It's just, in fact, they're a little weaker than you would think. And it's like, it's not clear why that is. But as you're saying, like, it's this disconnect and no one's quite sure, well, it should be working, but it's not quite now. And it's one of those moments where you just got to just see what happens a little bit.
Yep.
So definitely a theme. So obviously you're not into prediction, but when you sit there, what is there any, just to conclude the discussion, is there something you're looking for in particular, or a sector you're interested in, or anything that you want to sort of sum up what you'll be doing for the next 5 months?
I think the biggest thing is this disconnection. The fact that now, I think that there was a time where people were looking at the bond market, and gold did react for a time to the real yields, and then I think perhaps maybe 3 or 4 weeks ago, I think markets sort of realized, hold on a sec, this bond move is not a inflation expectations or growth expectations move. It's more technical. Therefore, they've stopped that. And I think right now it's very difficult to really get a grasp, if I look at watch lists. And so really, I'm just trying to look for when does the picture start to become a little bit clearer? And I think it's fine for us as traders, investors, to say sometimes, don't know what to do right now. It's quite murky. It's not as clear cut to be long risk assets right now as it was a few months ago. We're not quite sure, for example, with this Delta, variant going around. On the one hand, you could say it could be negative for growth. On the other hand, you could say it's going to mean that central banks are going to be more dovish going forward. I think that's definitely going to be the case. I think central banks that were thinking about potentially moving are going to be pushed back. Looking at the RBA, for example, the numbers here were looking really good economy-wise, 2-3 months ago. Well, any chance of tapering here has probably disappeared now with the lockdown. So, but, dovishness in the past has led to equity strength. Will it do that this time? We're not sure. I think it depends in different countries on the vaccination rates, because so there's so many unclear things right now. When I look at the markets and I look at the macro events, that I think it's a time just to scale back on risk, to put protection in place if you do have portfolios, and then wait for the picture to become clearer. Maybe, when we get more of a picture to become clearer, maybe it shows us that we want to be long risk assets. But you made the very good point earlier that we know equities are expensive on a historical basis. So I've always say, and I'm saying right now to people that, when you're looking at your portfolio, you have to look at that overall context of equities are expensive by historical standards. So, we can do various things. You can replace some equities with call options. You buy some put options for protection. But yeah, I'm just waiting for the picture to become a little bit more clearer, and to see how it manifests really that way.
All right. Well, thank you for coming on. I love talking to you. If you're up for it, I'd love to do more of these. Get you on more regularly. It's very
I love to.
Observation.
Again,
fun. I'll just give the book another. And I should say, I asked Gary on. He didn't push me to come and promote. I bought his book with my own money, and it's a really highly recommended read from me. All right, so we'll leave it there, and we'll come back hopefully and see what happens in a month or two.
Thanks very much, and keep well, and thanks for having me on.